where you can still get great deals. We actually think 2013 is going to be one of the best years to invest in investment real estate. Yep, this was going to happen eventually, wasn't it? Interest rates finally went up in June. Went up actually 4%. Doesn't sound like a big spike, but that was actually the largest one-week increase we've seen in 26 years. That was according to Freddie Mac. So interest rates finally did start to creep up. I also pulled this off just right after that. This is just right after that information broke, and this is again from Fannie Mae just saying that it's going to have little to no impact at all on home prices. Prices are continuing to rise. We don't see that having any effect, virtually no impact on home prices whatsoever. I think part of the reason that is because we're going to talk about this. There's a lot of institutional investors in this market today. Most of the larger hedge funds recognize the value in real estate. We believe that sort of started a year and a half ago when Warren Buffett was interviewed on CNBC, and they asked him, you know, is investing in single-family homes a good idea? And he said, I would buy 1 million single-family homes if I could, but I'm not very practical. What he was really citing was he was saying, yes, investing in real estate is a great thing to invest in today, but you got to have the ability to take care of it. And that sort of frames what Lori's going to be talking about with Summit Assets Group and some of the things that they do. But since Warren Buffett made that quote, you saw a lot of institutional money pour into the market. We've seen, you know, I believe the number is $9 billion hedge funds have committed to buying single-family residences in 2013. Warren Buffett didn't just say that buying real estate was a good idea. He went out and he purchased Prudential Real Estate. So he's now very much into the real estate business. July, CNN Money, talk about the long national foreclosure nightmare is nearing its end. Foreclosures filing hitting their lowest level since before the housing bust. So total foreclosure filings, including notice of default, scheduled auctions, and bank repossessions dropped to 127,000 in June. That's down 35% over the past 12 months. So we are absolutely seeing a slowdown of foreclosure filings. This was from Realty Track, by the way, who tracks these sorts of real estate statistics. So where's the housing market recovering? Where's the strongest and the weakest recoveries occurring? This is from Yahoo Finance. I just pulled this off a couple days ago. These are the top 10 metro areas that have recovered since the housing bubble burst in 2008. You can see Rochester, New York, 93% up. Cape Coral, two of Lori's chosen markets, Birmingham, Alabama, number 6. Atlanta, Georgia, up number 7. Interestingly, Birmingham, Alabama is rated the 3rd best cash flow market in the country. Ironically, Rochester, New York is considered to be the number 1 cash flow market in the United States. And then here's the ones that have recovered the least. Interesting, a number of places in California, which isn't surprising. I'm up in the central part of California, Fresno and Visalia, California. But the spot in Oregon, of course, coming in last is Baltimore. If you bought investment real estate in Baltimore, you probably haven't received much rate of return, if any, in that particular market. And again, as I mentioned, a lot of this has to do with the fact that, you know, institutional investors are buying up real estate in record numbers. They entered this market really a couple of years ago. We do deal with them. I deal with them. I know Lori Graymont deals with them frequently as well. They are aggressive buyers. Interestingly, they almost always buy at or above asking price. And interesting, when you talk to them about that, you know, gee, why do you buy at asking price? You know, we always try to barter a little bit and bring the prices down a little. Well, their take is that we're still buying way under market value. We're still getting great deals. So the idea is to get a lot of inventory. Of course, their strategy is, you know, a strategy that you may consider, which is to buy a piece of investment real estate, have it fixed up, do some rehab work to it, install a renter in there, earn a rate of return on your money, and then watch the market to appreciate. History tells us that the real estate market always cycles. There's downs, there's peaks, and there's valleys. And right now, while we are coming up, we certainly have not gotten near the peak, and which creates an opportunity to buy property at great value, which is what the hedge fund sees. Blackstone is the largest hedge fund in the United States. They're the largest owner of single-family homes in the United States. This was just from last month. Jonathan Gray was interviewed, and they asked, well, are you done buying? He says, not yet. And again, their strategy is, again, something you may consider. Isolate key markets for growth. Looking for 2 things. You're looking for appreciation as well as cash-on-cash return. And, you know, again, put some investment dollars into those properties, bring them into a rent-ready condition, and then rent them out and hold, and just sit back and watch your investment appreciate. The Chinese have sort of joined the party. Now, the Chinese investors have always been in real estate, but traditionally they've been more into hospitality and commercial real estate, not as much into single-family homes. They've recently invested $500 million in Blackstone, which means they're now very heavily invested in investment real estate. We are working with one Chinese group. They're very methodical. They're very thorough in what they do, but they also recognize an opportunity. And so they see this as a great opportunity to, sort of jump into the single-family residence game and put single-family investment homes into their investment portfolio. I got this off CNBC just a few weeks ago. What's the fastest way to triple your money? Housing? Yeah, it's housing. Housing is an absolute. This is the reason why you see the institutional investor in this business. This is the reason why you, as an individual investor, may consider using part of your 401k or self-directed IRA portfolio to grow your retirement strategy. Larger hedge funds, real estate investment trusts are sort of doing the same thing. They're seeing this as a way to invest their money and, again, watch the market appreciate. So that sort of gives you some ideas of what's going on in the market now. I'm going to turn it over to Lori now. Lori, I want to thank you for being here today.
I'm here, Charlie. Just took a moment to get off the mute here.
That's okay. And before we move on to Lori, we're just a reminder again, we're going to take questions at the end of today's webinar. If you've got questions anytime throughout the webinar, there's a little, you have a dashboard to the right of your screen. There's a little button that says questions. If you just push that, you can then type in your questions, and we will be glad, myself, Lori, or Brian will be glad to answer your questions at the conclusion of the webinar. So with that, Lori, I want to thank you so much for being here.
Thanks, Charlie, and thank you for all the educational information on the market. I think it's so important for people to keep up to date on this, and it's changing. It's forever changing, and so I just love your updates and how they, are timely. So I'm Lori Gramont. I'm a host of Real Estate 360. We are on the Wall Street Journal Radio. I'm also the CEO of Summit Assets Group, and I grew up in a family environment of real estate, so I live and breathe this. I've had pretty much all my life. And at Summit, we're here to create, I guess I would say, quality cash flow investments in markets that are trending up. We follow markets, we analyze them. Are they going to have room for appreciation? Are we still buying at a discount? Are they strong for rental? And are the homes quality? That's really what we're looking for, because in the end, when you exit your property, you're looking to exit it to a home buyer, somebody who's going to buy it to move into it. And so even though you can get investments in the $20,000, $30,000, $40,000, $50,000 range, they may not be ones that you're going to exit at a premium to a homeowner. And so you really have to look at what is your ultimate goal of this. We also provide note investments for investors who are looking to earn on real estate but not necessarily own it. And we educate, coach, and connect active investors in strategies that work. So if you're an active investor and you're looking for what's working in the marketplace, give us a call. Since 2009, we've bought and sold over 1,400 homes, and so we do have experience nationwide. So one of the things that we do is we watch the different marketplaces and try to pick markets that are going to work. So some of the things we look at for choosing a market is cities that had hard falls but are in a recovery mode. There's no sense wondering, are they still going down or are they still going up? You can find all that data, and so that's what we follow. We look for a net flow of people moving in. We look for affordable cost of living. Is the state and the city friendly to businesses? The same thing to landlords. Do they have a job creation agenda? Do they have higher education, quality transportation? And are they investing in the industries for the future? So if you think of Birmingham, a lot of people think of Birmingham as a manufacturing city. But the truth of it is they've really renovated the area. They've done a lot of redevelopment. They took out some poverty-stricken areas, and they've built a vibrant downtown. They have a world-class culinary scene. You might not think about that in Birmingham, but guess what? They do. They have the most green space per capita, and they're ranked 13th among the largest southeastern metropolitan areas. And they're 48th in population as far as where they fit in the metro area. So their population is 1.1 million. So here's some pictures of the development that they're doing. So whenever there is infrastructure improvements, That means they're creating jobs. They're putting money into the economy, which gets jobs created. The reason job creation is important is because that's what people use to earn money, right? They need money to pay rent. And if you have a house, guess what? You want them to pay the rent. So we always go into communities that are creating jobs. So here's some statistics about Birmingham. It's very similar in the geography as far as comparing this with Atlanta. And like if you were to look at the highways, they have a perimeter highway that goes around the metropolitan area. The suburbs are located on the outside of that perimeter. And that's where we invest, is on the outside. We don't invest necessarily inside. There are some places that we do invest that are inside, but mostly it's in the suburbs. It's where people are going to want to buy houses. It's where homeowners live. That's where we want our rentals. So Birmingham's been ranked second in the nation for building personal net wealth because they have good salaries and it's cheap living expenses. They're the most important business center in the southeast, and they're one of the largest banking centers. And you know that development you saw in that previous slide? They're investing over $1 billion to renovate the downtown area. So they have transformed themselves from being a manufacturing place to biotechnology and medical research. So if we skip over to Atlanta, you can see here the list of the Fortune 500 companies. There's about 15 in the metro area. And one of the things that Atlanta offers, that Birmingham also offers, is a diverse economic base, meaning that the employment sectors don't revolve around one industry. For example, if I say Las Vegas, your mind will probably go to gambling. If I say Detroit, your mind will go to car manufacturing. But if I say Atlanta, there's not necessarily one, except the Braves, there's not necessarily one thing that's going to come to your mind. But the thing is, on the economic side, if you're in 5 or more areas, you have diversity. So if one of them suffers a slowdown, it doesn't affect the whole economy of the city. And we always look to see if any one of those sectors has more than 30% of the employment, and none of them do. So that's a safe investment. Just like Birmingham is investing, Atlanta is investing, they're putting $2.8 billion in redevelopment. They're connecting 33 miles of trails and walkways, 45 neighborhoods. And this is creating 30,000 permanent jobs and 48,000 construction jobs. The cost of living is affordable. You know, average house in Atlanta is about $900 for a 3-bedroom, 2-bath, 1,200 square foot house. That same house in the San Jose market where I live is $2,400, if not more. Forbes ranks them as the 4th most affordable city to live in and the 2nd best city to relocate. And the one I like is the #1 city least costly for businesses. So they're attracting new businesses. When you go into a marketplace, buying a home is really actually the easiest step. The part that needs to be there is the support for the purchase along the way. If you're buying it for the cash flow, you're going to hold it 3 to 5 years. That's the longer period of time. And so you want to work with somebody who has experience. At Summit, we have 7 employees. We have over 65 years of combined real estate experience. In Atlanta and Birmingham, we have over 40 team members on the ground. And last year in Atlanta alone, we rehabbed 45 properties. We bought and sold over 1,400 homes. And our experience, the reason I share all this, is our experience helps reduce your risk, and it actually increases your profits. So I wanted to share with you a couple samples of our properties. This is in the Birmingham area. This house here sells for $92,000. And I know some of you who are in the West Coast and the East Coast probably think that's just a down payment, but no, that's actually the whole price for the house. Fully renovated, it rents for $1,150 a month. So that gives you a cash-on-cash return of about 10.6%, almost 11%. Another one here, this one's actually sold, $93,000. This was obviously before the renovation pictures. It rents for $1,200 with a cash-on-cash return of 10%, 10.4. Here's a picture before rehab of a property we have in Atlanta. This one is selling for $68,000, 1,300 square feet, and the projected rent on this is $900. So that's, again, almost 11% cash-on-cash return. And here's a newer home in the Atlanta market selling for $85,000, almost $86,000. The rent is $850, and so that gives you about a 7% cash-on-cash. Now, obviously, if you're going to finance these, you'd get better returns. But a lot of people don't do financing. They use their IRA money, which Brian's going to come in and talk to you about. Sometimes they use their IRA money partnered with somebody, and they come in and they just buy them cash. Because as you know, in the financing market, it's gotten harder and harder to get loans. And to do a loan at such a small loan amount, when you can only have 10, and the first 4 are really easy, a lot of people want to save their loan ability for something at a higher price point. So one of the things that we do is we work with you, and we try to find properties that are going to fit your needs. We ask you questions like, what is your plan? Are you looking for income or equity growth? Are you conservative or aggressive? Are you looking for short-term or long-term? And then we define it because our California friends, you know, long-term is a year. But actually, when we say long-term, we're talking 3 to 5 years. And do you care if it's, you know, in the slum, or do you have a pride of ownership? Single-family, multifamily, syndication, what are you looking for? And then do you want to self-manage, or do you want professional management? Most of our clients come in looking for growth of equity. They're building for retirement. They have a conservative risk tolerance. They're looking for 3 to 5 years. They like the pride of ownership, nice homes. They're looking for single family, and most definitely looking for professional management. So if that meets your criteria, if you're a little bit different, we just really encourage you to call us. Here's the process. First thing you do is you call into our office for a preliminary interview. We set an appointment with one of our investment consultants like Charlie or, you know, some of the other people in our office. We review your objectives, and then the investment consultant will send some properties that meet your personal objectives. You pick a property, you sign the contract, you send an escrow deposit to the attorney of $5,000. Then you have 10 days to do due diligence. You can cancel at any point in time. After those 10 days, you would fund the purchase and close. And then you start to receive rent, which is the perfect part. And then you repeat until you've built the portfolio you're looking for. So it's kind of like wash, rinse, repeat. All right, so our goal for you is to provide you with zero headaches. We want you to get the passive cash flow people talk about in owning long-term investments. Now, a lot of people come to me and say, well, isn't the market already saturated? Hasn't it gone up too much? I mean, you saw the statistics that Charlie had for both Birmingham and for Atlanta. But here I want to show you, in the Southeast, building a home is going to cost anywhere from $78 to $105. And that's per square foot. So in Birmingham, if we take 1,700 square feet, your cost to build, or I'm sorry, your cost to purchase is only $54. In Atlanta, our 1,300 square foot house, your cost to purchase is only $62. So you can see that you're still buying in cheaper than it is the cost to rebuild. And we know in statistics, everything returns to the median. You can't keep selling houses cheaper than it is to build them. So prices still are anywhere from 60 to 80% of replacement cost. Rates are at historic lows. And this is the piece that I really think is important to watch. Lenders are getting more relaxed than more stringent. And so when more money is available in the marketplace, it causes prices to continue to go up. So this is a perfect time to get in. Rents are expected to continue to increase. There's a shortage of inventory because foreclosures aren't happening. And we know prices are still affordable. So, Brian, you are up. Tell them how they can use their IRA money to buy these homes.
I will do so. Thank you, Lori. Thanks, Charlie. Yep. Get my PowerPoint up here. On one. All right. You guys see my screen okay?
Yep.
Yeah, Brian, we can
All
see you
right.
good.
All right, thank you. Well, my name is Brian Davis. I work for Accuplan Benefit Services. We're a self-directed IRA and custodian. I'll give you a little bit of background about myself and Accuplan. Make sure my slides want to move for me. Sometimes I start these things, they freezes up for a second, so bear with me. A little bit about myself. My parents are rice farmers up in Northern California and do a lot of real estate investing up in that area, north of Sacramento. I myself, I went to college down in UC Santa Barbara here in Southern California, just north of LA, for those of you out of state. And then after I graduated college, I moved down to San Diego and got into doing loans. So during the 2002 through 2007, I was doing loans like a lot of other folks. So I got to ride, quote unquote, the last wave up, and I was working in a builder division here in San Diego, California, where I live, and watched the growth go up really fast. And then at the end of 2007, kind of watched it cool off big time. Moving forward, I'll get through this disclaimer real quick and we'll move forward. Accuplan, we're a third-party administrator and custodian. We're not financial advisors. All information presented is for educational purposes only. Please contact your accountants, CPAs, attorneys, and before entering into any type of financial situation. So that's a little bit about myself, explaining where I'm from, what I've seen in the real estate market. I've been doing self-directed IRAs for over 4 years now and opened almost 1,000 accounts at this point. Accuplan, we have our own trust company which allows us to be an IRA custodian. It's called American Estate and Trust. And we offer IRA services for IRAs and solo 401ks. And we help it so you can take your IRAs and invest in assets like real estate. So IRAs were kind of developed after the ERISA Act of 1974 by Congress. And it outlined the present IRA system we see today. And it said you had to have a custodian to make investments with your IRA. Well, that industry is dominated, as most of you know, by the investment banks, brokerage houses, and insurance companies that offer traditional assets such as stocks, bonds, mutual funds, ETFs, and in the case of insurance companies, annuities. So a lot of folks, attorneys and financial planners, they don't know all that much about the self-directed IRA, and hopefully I can shed a little light on it for some of you today, and for some of you that know a little bit about it already, maybe a little bit more. At the end of 2010, there was just under $5 trillion in IRAs. That does not include 401k type plans and other pension plans like that. 98% of them were with the traditional brokerage houses and insurance companies. Only 2% of people's retirement funds were able to invest in this broad range of investments like real estate and notes. This number's starting to grow. Last year when Mitt Romney was running for president, his financials came out and it came to light he had a self-directed IRA himself worth somewhere around $100 million. Now, that's pretty extreme, but what I would give to Romnetize my IRA, so to speak. So let's look at what we're seeing here at Accuplan. As Lori and Charlie are talking about real estate, that's our top asset class that we see here at Accuplan. I would say notes and loans, which Lori offers as well as another top one, as well as investing in private funds. Those are the top three that I'm seeing. I rarely see the precious metals account, so I'm sure some of you have seen those ads on TV saying, oh, invest in gold with your IRA. That's what we do as well. I really mostly focus on real estate with that being my background. All types of different investment options you can make, as this slide shows here. Trust deeds, you can buy foreign real estate, oil and gas, you can joint venture with others, notes, private placements. The IRS put out a list of what's an acceptable investment, only what's not acceptable. And they really only listed 2 things that your IRA can't invest in. And as this slide shows here, that would be life insurance contracts and what the IRS deems as a collectible, which is like a work of art, drug collection, alcoholic beverage, anything illegal. And there's even some exceptions to some certain coins here. S-Corps. S-Corps don't allow IRAs to be members of them. That's not an IRS rule, that's an S-Corp rule. So you'll hear that as well when doing any type of educational digging in the self-directed IRA. The main thing that we do want to talk about is the things to look out for are what's called a prohibited transaction. A prohibited transaction is when your IRA gets involved with what's called a disqualified person. So let's cut through the jargon. Prohibited transaction, disqualified person. This is people your IRA can't do business with. And this is outlined in Internal Revenue Code 4975. You're free to Google it or ask me questions about it. Essentially, there's no self-dealing in the IRA. Besides yourself, your IRA can't deal with your spouse, parents, grandparents, kids, grandkids, and their spouses. So you want to think about it in a straight line, up and down. That's a no. Side to side can be okay. And any company, essentially, that yourself or one of those persons is the majority owner of. And it gets more specific if you look into the notes, but these are the main highlights here. So we'll play a little game here for those of you following along, because you don't want to get involved in a prohibited transaction. If the IRS finds out your IRA has been involved in one of these prohibited transactions, it can disqualify your whole IRA. And I always give the example, let's say you buy a property, not a turnkey one like the ones that Lori has here, but you buy it yourself with your IRA. Maybe you pay your kids to paint for you. Well, you just did business between your IRA and a disqualified person, your kid. That could disqualify that entire IRA and everything in it, and that could be a huge taxable event for you. So let's go through some examples. Everybody remembers the game Deal or No Deal from NBC a couple years back, and I was just in Vegas a couple weekends ago, and they have plenty of slot machines with this on there, so that's how it's still relevant to me, I guess. So as an example, can your IRA lend you $10,000? Deal or no deal? That's no deal. That's self-dealing. That's the definition of self-dealing. You can't lend your IRA can't lend you money. What about your brother? Can you lend your brother $10,000? Deal or no deal? This one's deal. Again, he doesn't fall in that straight line up and down. He's a side to side. What about your stepson? $10,000. That one's deal. If he's not blood related. I don't make these rules from the IRS. I just try to help interpret them for you. And here's a last example here. Daughter-in-law. Daughter-in-law, $10,000. Deal or no deal? This one's no deal. Your children and their spouses. So it can get a little tricky. So if anybody has any questions about that, what they're doing in their IRA, who it's doing business with, feel free to ask us, because you really don't want to get caught in an audit by the IRS and for them to dig up something. The next big point is, all right, I understand the IRA a little bit. How do I get started? Well, you're going to put money into one of these self-directed IRAs. So how do you do so? Well, if you have an existing IRA, we do what's called a trustee-to-trustee transfer. So it moves from your existing IRA custodian over to us. And just because we're self-directed, it's really a marketing term. We have the same type of IRAs as every brokerage house with, traditional IRAs, Roth IRAs, SEP IRAs, and simple IRAs. Well, what if you're in a qualified plan like a 401k or 403b or some type of pension plan? You want to do what's called a direct rollover. So you move the funds directly into the name of the IRA. You don't want to take it as a distribution and then move it to the IRA. You want it to go straight to the IRA. The question I get asked here is, well, what about my existing qualified plan? Can I move those funds into an IRA? And the answer to that is maybe. You need to talk to your plan administrator if your plan allows what's called an in-service rollover, meaning that they'll allow you to roll those funds over to an IRA while you're still in service. From what I understand, this would be more along the lines of a qualified plan or a pension plan that would allow this, and probably only if you're 59.5 or over, but it's something to ask. I do find people are able to do this. I have a client that opened up an account today that he went yesterday and talked to his plan administrator, and he's allowed to move out 50% of his plan assets. So it does happen. The final and third way to move money to an IRA is to make an annual contribution. Most people fall into the category of a traditional or Roth IRA. A traditional IRA works just like most people's 401k plans that people are familiar with, except when you make the contribution, it's a tax deduction, and the funds grow tax deferred. When you take those funds out at retirement age, you're going to get tax on that as earned income. With the Roth IRA, it works a little different. You're not going to get the tax deduction on putting the funds in, but when they keep growing, they grow tax-free. So when you pull those out at retirement age, you're not going to have to pay taxes on that big amount. There's some more intricacies to those types of IRAs. If anybody has questions, please let me know. And then we see for the self-employed individuals, SEP and Simple plans. A SEP IRA works very similarly to a traditional IRA as it's a pre-tax plan, but it's for the self-employed individual. So it counts for self-employed pension. And the self-employed individual can contribute up to 25% of his income into the plan with a cap at $51,000. Now, if they have employees, they have to provide them with the same percentage that they provided themselves off the employee's pay. So it's something to look into. And then there's a simple plan that I rarely see, but it's similar to a 401k plan where a company might have a simple plan and allow their employee to put some money aside, and the company can match. The limit on that is $12,000, which is a lot lower than the 401k. And you also see this individual K. An individual K is a subset of a 401k plan, and it's for the self-employed individual with no W-2 employees. And it works just like a 401k plan. So if you're self-employed, no employees, you can put money aside as both employee and employer. It doesn't matter if you're set up as a sole proprietor or you've incorporated yourself as an S Corp, a C Corp, an LLC. You're allowed to make these contributions, and you're even allowed to make an extra $5,500 if you're over 50 years old. So if anybody has a question, I'm going to jump on the individual K in a little bit more, but I'd like to go through an example here. Let's say you want to buy a real estate property with your retirement plan. This one you're going to rent it out. We have John here who has a SEP IRA. He wants to buy this property for $100,000. He transfers over a little bit more than that. He brings over $125,000 just in case he needs to make repairs or pay the plumber, anything like that. So he has a little buffer in there to make payments, because when you buy a property in your IRA, all the expenses have to come from the IRA. You can't pull those out yourself. But again, that would be doing business with yourself and your IRA, prohibited transactions. So you want to make sure you have enough funds in the IRA to do those types of things. So the first step is he makes an offer to purchase the property in the name of our trust company, American Estate and Trust, FBO, John Wood, SEP IRA. He directs us with the direction of investment letter and the purchase contract to buy the property, send the escrow deposits, title, and closing. He reads and approves all documents, or what we generally have is we have an authorization form for us to sign all documents on behalf of the IRA that the client signs. And then we wire all the funds to the title company to close. The deed's recorded and sent to us for safekeeping. So this is how the deed's going to read. American Estate and Trust, FBO, John Wood, SEP IRA, and then they have the address of our corporate headquarters here in Las Vegas, Nevada. Again, it's kind of self-explanatory, but just wanted to walk everybody through that process. If anybody has any questions, feel free to write them in the chat box, and hopefully we can get to them at the end. So here's how it goes. John decides to hire a property manager to keep it hands-off and keep it a little simpler. The property management company finds a tenant. Everything's handled by the property manager here. And the condo here is cash flow of $450 a month. And it's tax deferred because it's a SEP IRA, unlike a Roth IRA, as it says here, which would be tax-free. So a couple years later, he finds somebody. The tenant offers to purchase the property for $150,000. Just like during the purchase, we have to coordinate the closing with the title company. John reads and approves all documents, and all the funds go back into a SEP IRA, tax deferred. So how does that look? $100,000 initial investment. His rental positive cash flow, $10,800, and then a $50,000 gain from sale. So he's able to earn 61% over 24 months, or $60,000 off this $100,000 investment in 2 years. This is happening. The last couple of years, the markets have been showing this. You know, 4 years ago when I showed this slide, I said, oh, this is a nice, easy example to show. But you know what? Times have changed the last few years. The cycle has been going up. This is actually happening. And this is why if you're able to take advantage of this from your IRA, it's a possibility now. You're not stuck with those traditional assets of stock, bonds, mutual funds. Some people even go a step further, and they do what's called the checkbook IRA. Now, the checkbook IRA allows the IRA owner to have all the funds available at the tips of their fingertips. So you want to make sure you're very comfortable with the rules of prohibited transactions before even thinking about a checkbook IRA. Now, most people know the checkbook IRA using the LLC approach. In this method, the IRA owns the LLC. It's the member, the sole member of the LLC. The IRA owner becomes an unpaid manager of this LLC. Back up here, some of you might be confused. Well, Brian, I thought you said that you're a disqualified person from your IRA. That is true, except if you enter a transaction from the very beginning with it and you don't have any personal interest in it. So in this case, again, your IRA is the one funding the LLC. You're the one running it as an unpaid manager. So this is allowed. So like I said, your IRA is a single owner, so it's called what's called a pass-through entity. So there is no federal tax return if it's just a single member, your one IRA. However, it must pay a state tax. Whatever state it's in, they'll have in California, I know there's a franchise tax board fee and a gross receipts tax, and every state's fees differ on that. And that's something we can help set up, or you can have set up on your own. A new, more popular method that's been coming out is what's called a business trust. Very similar model as the LLC, except it's through a trust instrument. So the IRA in this circumstance, in a very similar structure to the LLC, is the beneficiary owner of this trust. It's also the grantor and settler of this trust. The IRA owner is an unpaid trustee. It's a pass-through entity just like the LLC, but it's not a state instrument, a trust or a federal instrument, so it doesn't have to worry about paying any type of state taxes. So it's a great contrast depending on what state or states you're doing business in and not having to worry about filing or paying any type of state taxes. And if anybody has any questions about this product, you can check out retirementcheckbook.com. So going back to the 401k, which we talked about earlier, it works very kind of similarly to these checkbook IRAs in the fact that you are your own trustee of the plan. So these plans come, you buy the plan, you adopt it to yourself or to your corporation, and you can invest directly from your 401k. A lot of custodians will make it so you have to hold the funds with them and then maybe buy it in people. You don't have to. You can directly buy from the 401k plan, or you can create a separate holding company or LLC to direct the investment. So if you have a corporation or not, you create the 401k. You can roll over any other pre-tax retirement funds into the plan, or just start making your contributions and then direct investments from there. You can loan yourself money as a plan participant in the 401k plan. That's the benefit of it over the IRA. 401ks fall under some different rules than an IRA. So just like a company 401k, if it's a solo 401k, you can, as a plan participant, as the employee, you can take loans out against your own retirement fund, and then you pay back your IRA with interest. So it can be a nice little tool here. The IRA, which most people fall under, is fairly simple. You open up an account. Just like we said, we work on funding it, transfer, rollover, contribution, and then you direct us to invest in what it is you're looking for. We're about a 24 to 48-hour turnaround time and put in terms of putting an asset in your account, and everybody has 24/7 access to their account online. So again, you're not limited to the stocks, bonds, mutual funds out there. Real estate is a viable option in your retirement funds, and there's a couple different vehicles to do so with. So that's all I have. My name is Brian Davis. You can reach me by email, as it says here, briandavis@accuplan.net, on my site, accuplansandiego.com, and that's my cell phone number right there. So feel free to contact me with any and all questions you might have. So with that, Charlie, Lori, any questions for me? Or any questions?
A couple here, Brian. I just want to say I learned something new every time you do one of those, so thanks very much for all that information. That was really good, very well presented.
Thank you.
So Brian, there is one topic that I'd like you to, if you could, touch. We often have spouses loan their money together. I said loan. I meant put their money together just of a property. And one of the things you talked about is, working with your spouse is prohibited, but there is a way that they can do that, right?
Yes, exactly. And it's similar to the strategy of the checkbook IRAs, where if you set up the transaction from the beginning, you got to keep it in those percentages. So let's do a quick example. Let's say you want to buy a property, you and your spouse, for $100,000, and you're doing it in your IRAs or personal funds, whatever. Whatever you make the offer in, let's say you do it with your IRAs 50-50 with you and your spouse, those percentages are locked in. So let's say Joe Wood bought it with his spouse Jane Wood. So they'd buy it in the name of American Estate and Trust, FBO Joe Wood, and then in parentheses an undivided interest of 50%, and American Estate and Trust, FBO Jane Wood IRA, an undivided interest of 50% as tenants in common. So the big thing when buying it with yourself or another disqualified person is you have to set it up from the beginning. So yeah, we're getting to the more advanced investor strategy here when we're talking about the checkbook IRA. We're talking about it with investing with one of those disqualified persons. The issue is you can't come in after the fact. So you can't have the purchase contract in one of the names and then assign the other one being 50-50 later. That would be considered a prohibited transaction. But if they came in from the beginning and went forward in those same percentages, so all income and expenses were back out in those same 50-50 percentages in my example, it could be whatever percentages it is, but that's how that works. Did that explain it thoroughly enough?
I think so. We do see that people will sometimes partner with each other, or even with their personal funds, that they'll, do some of their IRA and some of their personal funds, but it has to come into the contract at the percentage at the time of writing the contract.
Yeah, exactly. Just you want to keep those percentages the same, and just because you buy a property with your IRA, that's fine to do if you set it up correctly, as Lori and I are talking about. That doesn't give you any avenue to use that property personally. So even though you own the property personally with your IRA, if you use it, you just disqualified your IRA there. So it can be a slippery slope. And a lot of times what people will do is they'll create one of these LLCs or business trusts with each other and then have the entity buy it to keep the percentages a little bit safer, because then everything just goes back into the entity, the trust or the LLC, and then they'll back out of the entity later on during that time. But it's that same concept, but going directly through the IRA. Yeah, thanks for bringing that up.
Mm-hmm.
I got a couple questions here. I'll ask the easy one first, Brian. This is to you, Laura. I got two for you here. At Accuplan, what are the fees to manage a self-directed IRA?
$275 annual fee, a one-time setup fee of $50. Your first 6 transactions are free. After the 6th transaction, there's a $35 transaction fee. And the other thing is we charge $15 for wires.
Okay, Lori, I'm gonna bundle these two questions together because they're sort of similar. What is the price? What is the typical price range for single-family residence purchases in Atlanta/Birmingham, and how can I look at your homes?
Okay, so the typical price in Atlanta, and we range between $60,000 and $130,000. Your middle of the road is going to be the $95,000, and those are going to rent anywhere from $900 to $1,100, depending on the house that you get, the age, all that kind of thing. The Birmingham homes are usually in about the 100 range. They're a little bit higher, 100, 120,000. They most typically rent for $1,100 to $1,500, and I think, was there more to the question? I'm trying to think, was there more to the question than that?
How can somebody look at your homes, your available homes?
Okay, so the first thing is call into the office and let's make sure that we pick out some homes that meet your personal profile, your personal investing goals. And once you've decided on a home and you've put up the escrow money, what we can do is we can get you into one of the homes to do your due diligence, whether you want to go or whether you want to hire an inspector to go. A lot of our clients will hire an inspector because they want somebody who's a professional, licensed, to do the walkthrough. I mean, we can all walk through a house and go, ooh, ah, it looks good, but we're not buying on cosmetics. We're buying on the structure. We're buying on the fact that it's cash flow. And so most of my buyers, I'd have to say almost 99% of my buyers buy sight unseen, but that does not mean sight uninspected. They hire a professional inspector to find out what's good about the property, what's wrong with the property, and, you know, just so that they're going in with their eyes wide open. So start out with a phone call to us, and we'll get it set up.
Yeah, I was going to say the key thing is to identify your strategy. Where you want to start in this process is simply having a good understanding of what you want to invest, how long you want to be in the investment. You want to take a real good look at what your own personal set of goals are. Based on that, then we could certainly show you some things that we think might be a fit for that. We've got more questions here. Okay, what is the cost for an inspection?
Typically, it's anywhere from $250 to $375, depending on who the inspector is and your negotiating skills. I always tell people negotiate.
Okay, do you offer information on an overview on the neighborhoods and where you sell? So in other words, do you offer an overview on the type of neighborhood you're buying in?
You know, we can do that over the phone. You know, we kind of classify our neighborhoods in A, a B, a C. An A neighborhood is a nice neighborhood, pretty much where we live. You're not going to get the best rent to the purchase price in an A neighborhood, but you're probably going to see more appreciation just because it's a higher valued neighborhood. B is really where we try to focus most of our purchases and then our sales on, because that's where you're going to see appreciation and you're going to see cash flow. And then a C neighborhood is a neighborhood where it's mostly you're going to see a lot more rentals in that neighborhood. It might be a place where you see first-time home buyers, but it's strong rent for lower prices. And so we would classify them that way. Now, if you're looking for demographics of the neighborhood, the best I can tell you is head out to the internet. There's lots of different sites that search that up. Every house that we have, we hold in our inventory. So we purchase it first. And so we're very picky about what we're purchasing. We're not going to be buying in crime-ridden areas that are unsafe, because if I'm going to own it, I want to know that I can go visit it and be safe. And one of the things that people say is, oh, you buy every house, you must keep all the good ones for you. And I laugh, because it's actually the opposite. All the good ones sell quickly. And so any of the ones that you know, people for some reason decide they don't like them, I get to keep them, but I love it because I'm getting the cash flow, and so I don't lose either way.
Okay, there's a few people with their hands up. We have too many folks in this phone call to open up the phone line. So if you've got your hand up with a question, type it into the question. Just look below. There's a little button there that says questions. If you click on that, you can type your question into that. And then if you don't want to do that, we've kind of gone back and forth between Brian's screen and our screen, myself and Lori's contact information. You're more than welcome to give us a call as well to discuss. Lori, there was one other question here, and this sort of fits into what we've been talking about. The question is, are you interested in looking at any other markets? So I don't know whether you want to talk about any other markets you might be looking at.
We've already identified another market, but right now we're in Atlanta and Birmingham. We don't feel that, you know, they're bad markets. We think that people ought to invest in these markets still. Atlanta has at least another year before it's outpriced to the rent ratios, and I think that it's a very strong, solid market to be in. And Birmingham, I feel the same way. I don't feel like Birmingham is going to appreciate as quickly as Atlanta, but you're going to get strong rent ratios there. And so if you're in it for, let's say, a 5 to 7 year hold, and you want to get into a depressed market that's in recovery right now, I would say go for Birmingham, because the rents are fabulous to the prices. mean, it's almost like Birmingham is where Atlanta was 2 years ago. And when I was pitching Atlanta 2 years ago, people thought I was crazy because the news was still saying Atlanta's falling, but the truth on the street was Atlanta had already turned the corner. And we're seeing that same thing in Birmingham. A lot of people say, Birmingham, well, aren't they still depressed? No, they're not. I mean, maybe the news is, because the news is always anywhere from 3 to 6 months behind when they're talking real estate trends. But the feet on the ground have proven that the trend has turned and prices are going up. So Birmingham is a key market to get into. And so, you know, yes, we will have more markets we're going to open, but at this point, these are the strong markets we're recommending.
Okay, I don't see any other questions in the queue. I still see some hands up. So again, if you'd like to talk to myself or Lori or to Brian, give us a call. And if that's all the questions, I just want to thank everyone for being here today. Brian, thanks so much for doing this.
No problem. Thank you guys for having me. It was a pleasure, and let me know what assistance I can be, and talk to you guys very, very soon.
Sounds good. Lori, thanks so much again, and thanks everybody for being on with us today.
Yep, thank you, everyone. We look forward to hearing from you.
Bye.